Welcome to RBC's Markets in Motion podcast, recorded April 28th, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, earnings sentiment has stabilized a bit, helping stock prices find some footing for the moment. Second, we run through our thoughts on what we learned from last week's earnings calls. We think there are two different perspectives at play on the consumer, which may be adding to investor confusion. We exited the week seeing managing tariff impacts among corporates as a work in progress, but with a greater appreciation of the work that has been done. If you'd like to hear more, here's another 5 minutes. We'll start with takeaway number 1. Earnings sentiment is holding at a non-crisis low for now. We're still in the middle of the busiest stretch of S&P 500 earnings reports for calendar 1Q. Here are a few of the things jumping out to us on the stats. First, companies beating consensus are still outperforming in terms of immediate stock price reaction, while those missing are underperforming. So we think earnings do matter. Companies beating consensus are actually outperforming stock price-wise in terms of that immediate reaction, a bit more than we normally see. Second, the bottom-up consensus 2025 earnings forecast for the S&P 500 has stabilized around 265. That stat, which had been sitting comfortably above 270 for most of calendar 1Q, has been falling in recent weeks, but it was stable over the past week. And third, the rate of upward earnings estimate revisions to consensus S&P 500 EPS forecasts fell to 28.5% last week. That's in line with the lows of 2012 and 2016. This kind of reading is often the bottom in a non-recession or crisis period of downward revisions. In a more dire scenario, it typically heads to the 10 to 20% range. Overall, we see the process of lowering earnings forecasts as a necessary step in the market bottoming process. There's been enough progress and stabilization to help stock prices find their footing for now, though another major leg of downward revision seems likely if financial market participants start to bake in recession. Let's move on to takeaway number 2. We were drinking from a fire hose of earnings last week. We spend a lot of time during reporting season reading through earnings call transcripts looking for macro insights. What we read last week, limited to S&P 500 earnings calls held Monday to Thursday, continues to keep us in the camp that recession is not a foregone conclusion, but also adds to our concern that investors have gotten too worried about the near term and not worried enough about the intermediate to longer term. We also think there are two different perspectives at play for the consumer, and that may be adding to investor confusion, even though both seem legitimate. Overall, we exited the week seeing managing tariff impacts as a work in progress among corporates, but with a greater appreciation with the work that's been done already. So digging into the details a little more about what we read, trying to get through last week's transcripts, as the title of this podcast indicates, truly felt like trying to drink from a fire hose. Not just because there were so many companies that reported, but because companies finally provided detailed commentary on tariff exposures and sensitivities, and began the process of adjusting guidance to account for the policy change. We've been very open about our desire for companies to be more forthcoming in their discussions of tariffs in recent months. Recognizing that we're getting exactly what we asked for, we will acknowledge it's going to take some additional time for us, the sell side broadly, and the buy side to digest the information we're getting. On the broader macro, companies tended to rely on words like uncertain, volatile, dynamic, softening, and conservatism. Some noted they're modeling multiple scenarios or are shifting to quarterly guidance away from annual guidance. Companies varied in terms of whether and to what extent they're baking tariffs into guidance. Several alluded to the idea that they hope to gain more clarity and certainty over the next 90 days. Overall, it felt to our team at the end of the week like the tone just wasn't nearly as bad as expected, given how challenging financial market conditions have been recently and how weak sentiment surveys have been coming in. Several companies on the macro also referenced the idea of a better currency backdrop given recent dollar weakness. One of the debates we've been monitoring is whether anticipation of tariffs has resulted in pull forward or pull back in demand. For now, the answer to this question seems to be that it's varied a bit. Some companies have indicated they or their customers have pulled forward demand, especially on the industrial side. Others talked about having seen a pause or slowdown in CapEx plans or decision-making among their customers. Some companies were just adamant that there's been no change in behavior that they've observed. With many financial companies still reporting last week, one thing that did jump out to us were references to greater investor interest in markets outside the U.S. and damage to the U.S. brand abroad. One of the things we've been talking about in our own meetings recently is how some of our indicators like AAII sentiment, earnings revisions, Michigan consumer sentiment, and small cap PEs have hit typical recession or non-recession lows, helping stock prices to stabilize. But there are likely to be some lasting wounds, such as international investor interest in the U.S., that may just take some time to heal. Last week, it became a bit more clear to us that there are two tales of the consumer going around, and both may be correct. They're just capturing different perspectives. Financial-related companies, along with telecom companies, continue to describe the consumer as solid and still spending, with most of the stats they track on consumer health still okay. Some noted this seemed likely to be because they still have jobs. Others argued that the consumer is being disciplined and not overextending. By contrast, consumer companies continue to have a more negative tone when talking about the consumer, with a number highlighting value-seeking behavior even at the higher end, how uncertainty is impacting spending, leading to pauses on some purchases like big-ticket items, and pull forward in other instances like for mobile devices and cars. Bad weather impacts in 1Q are also coming up, and the impact of stock market volatility on consumers is also being referenced by a few. Digging in deeper on tariffs themselves, recurring themes beyond what we've already mentioned included the idea that many companies believe they have the tools to manage through in the near term, but impacts will start to be felt in the second half or 2026. Many companies indicated they would push through increased costs via pricing, and some said they were already seeing price increases from suppliers, but others noted that pricing would have to be reset in contracts down the road. Many noted a desire to mitigate impact and emphasize partnership with their suppliers and customers. Mitigation strategies included cost controls, though we did not see any meaningful discussion of layoffs or headcount reductions, along with supply chain footprint adjustments. A number of companies indicated China tariffs were the biggest problem and emphasized USMCA compliance or exemptions. Several companies also pointed out that it's going to take time to fully adjust for the new tariffs, along with the unpredictable nature and complexity of the situation, and some also expressed uncertainty around reciprocal tariffs in particular. A number simply said, more color will be coming. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.